When you or I want to borrow money, we'd go to a bank and put up our home or something valuable as collateral. When the world's richest people want to borrow money, they can put up or pledge some of their shares in public companies as collateral for lines of credit instead of selling shares and paying capital gains taxes.
Pledging shares is when an individual puts up their stake in a public company as collateral to take on personal lines of credit. That debt can be for any number of reasons, whether it's buying real estate, investing in other companies, or even buying more stock of the share that's being pledged. The benefits for pledging are pretty straightforward. It allows shareholders to access cash while preserving their power within a company and avoiding capital gains taxes. Since 2006, the SEC has required all public companies to disclose pledged shares of executive officers, directors, or individuals who hold more than 5% of a company's outstanding stock. It's also important to note here that billionaires are doing the majority of share pledging, at least in terms of value. There are currently 560 executive officers, directors, and 5% plus shareholders who are currently pledging shares, but just 32 members of the Forbes 400 list of richest Americans account for the vast majority of the aggregate value of all pledged shares in the market. Tesla CEO Elon Musk is the richest and most famous pledger of company shares. But I think the more revealing and interesting example is actually Larry Ellison, the Oracle co-founder who boasts a fortune of over $100 billion. Ellison has been pledging his Oracle shares to take on debt for at least 2 decades. In 2018, Oracle's board of directors started prohibiting share pledging, but Ellison, the only Oracle employee to ever report pledging shares, was also the only individual exempted from the new company policy. For critics of billionaire borrowing, Ellison is something of an ideal case study. The billionaire has seemingly used pledging to finance his real estate spending spree, including an estimated $300 million on the Hawaiian island of Lanai, while preserving his power at Oracle.
More than 2/3 of S&P 500 companies ban all company employees and shareholders from pledging shares for debt. 22% prohibit pledging, but with exemptions for certain individuals, and only 3.4% fully permit it.
Share pledging is a corporate governance issue. It's something that outside shareholders and institutional investors frown upon. The larger the company, the more likely they are to attract sophisticated institutional investors who have certain expectations on corporate governance matters like pledging. They say that pledging creates a misalignment of incentives between shareholders. The idea here is that pledgers, by diversifying their wealth through debt-financed investments, are essentially reducing their immediate economic interest in a company's success. The bigger risk, though, is that pledgers face margin calls against loans they've taken out. If the price of a pledged stock falls, a lender may demand the borrower put up more collateral to secure a loan. If a pledger isn't liquid enough to do that, then they may have to sell a significant amount of the company stock being pledged, which can put further downward pressure on the share price and generate more anxiety amongst outside shareholders. Margin calls against pledged shares can risk spiraling into a domino-like effect on the stock.
Many companies don't make arguments against pledging, but defenders of the practice, including Tesla, argue pledging creates a fiduciary relationship between pledgers and shareholders. In 2018, the electric car maker argued that pledging gives, quote, executive officers flexibility in financial planning without having to rely on large cash compensation or the sale of company shares, thus keeping their interests well aligned with those of our stockholders while also mitigating risk exposure to the company.
When we talk about share pledging, we have to keep in mind that it is a limited slice of the overall pie of assets that are being pledged for debt in the market. And when it comes to the world of billionaire borrowing, there's still a lot we don't know. Individuals who collateralize private stakes or diversified baskets of securities for which they're not serving as a director or executive officer, we don't have information on those pledges and the debt that's being taken out against those pledges. So while pledged shares offer a window onto the world of billionaire borrowing, it's still a pretty murky world, and there's a lot we don't know.